Okay, so we are going to have the next session before lunch. And for our paper, we'll have Charles Wang presenting his paper with Elliot, Tobin. And Charles, it's yours.
All right. Thanks so much. Thanks for including this paper in this great conference. It's about 6 o'clock in Boston, which means by the end of this talk, I will likely be fully awake. And my singular goal for this presentation is to make sure that most of you are still awake by the end of this. Okay, so this is a very straightforward paper where we examine the impact of legalizing share repurchases on corporate investments. We're going to do so by leveraging the staggered legalization of share repurchases across 17 markets around the world between 1985 to 2010. The paper is essentially a follow-up, an extension to a JFE paper that was published in 2021 by Wang, Yin, and Yu. And there's many of us Wangs. This is not, I'm not writing a follow-up paper to my own, who show or claim that legalizing share repurchases lead to lower investments, at least among some subset of firms, in particular the repurchasing firms. In our study, we look at a broader set of companies, all the public firms that stand to be impacted by the legalization of share repurchases, and we don't find evidence of a decline in investments. What we find instead is an increase in investments consistent with the idea that legalizing repurchases stimulates investment consistent with facilitating the flow of capital. Okay. In earlier versions of this paper, when we first presented, this is still quite early, people asked us, why do you choose to spend your life being mean? This is not the reason why we want to do this. The reason why we decided to engage in this project was in part because stock buybacks, as I'm sure most of you know, has been one of these lightning rod topics in the realm of corporate governance. Since at least 2014, there's been significant and growing concerns about the impact of repurchases on investment. Where this began was in part this 2014 article by an economist by the name of Bill Lazonick, who collected data on the S&P 500 company and showed that over a span of a decade, from 2003 to 2012, if you look at total shareholder payouts, that's dividends plus buybacks, as a proportion of total net income, that ratio regularly exceeds 90%. And indeed, when Jesse Fried and I looked at this ratio over different decades, this number is quite robust. Lazonick's interpretation or inference is that at this level of shareholder payouts, that leaves very little for investment in productive capabilities or higher income for employees. He focuses criticism in particular on stock buybacks, we think perhaps because they account for the majority of shareholder payouts in the US. Now, when this piece of evidence came out, that really lit the corporate governance arena on fire. Corporate lawyers picked this up. Marty Lipton declared that at this point, theoretical debates about short-termism and corporate governance, this is over. And it's been superseded by observable, quantifiable trends and behaviors, and then goes on to cite this particular piece of evidence. Think tanks picked this up. Long-term investors picked this up. Politicians, senior senators, presidential candidates, not only from the left, but also from the right. And it's not just that there were people talking about this, it's that led to a series of legislative proposals to either restrict or outright ban buybacks. None of that really happened, but they did culminate in 2022 in Joe Biden's 1% tax on stock buybacks as part of the IRA, a number that is now has been proposed to go up to 4%. Currently still remains at 1%, okay? This is the reason why we thought this paper was worthwhile revisiting. But given these concerns, given the interest to legislate, to regulate stock buybacks, we think it's worthwhile to really ask ourselves, are these claims, are these concerns really warranted? In this paper, what we're going to do is to ask whether or not the legalization of buybacks lead to a decline in corporate investments. If this is true, for what kinds of firms is this true, and why or why not? Okay? Now, these questions remain open in the literature. We have a lot of associational evidence, but not a ton of causal evidence. We have evidence showing that repurchases tend to be negatively correlated with investment, but we know that could be both consistent with a causal relationship, but could also reflect the fact that repurchases reflect diminishing growth opportunities and excess cash. We have surveys. Alon has a survey, earlier survey that shows in which CFOs say they tend to think about investments first before they think about how to distribute. In a more recent survey, John Graham shows that CFOs say dividends are more likely than repurchases to crowd out investment. My work with Jesse, we show why Lazanik's evidence doesn't really show what he purports to show, because this ratio that he looks at misses out on several important things, including issuances, both direct and indirect, which are significant. And in the denominator, he doesn't really measure investment available income. And we argue that when properly measured, the ratio of net shareholder payouts to investment available income is really closer to 20 to 30%. Now, this might still be too high of a number, but to the extent this is a problem, this is like an order of magnitude smaller problem than what Lazanik seems to be worried about. Okay? And in a recent survey of this buyback literature, Boname and colleagues, they call for research that provide more causal evidence on the extent to which repurchases might come at the expense of long-term investments, saying that this is policy relevant, it's important for the debate about corporate short-termism. Okay, now, Wang, and Yu is a fairly recent contribution to the series of questions. And they do a nice job identifying the setting, the staggered legalization of share repurchases in markets around the world. They find causal evidence that this legalization seems to lower corporate investments among repurchasing firms. They do a nice job defending this plausible identification strategy, confirming at least statistically that the timing of repurchase legalization is not related to pre-existing country year level conditions, and then arguing that these results are not likely to be driven by chance. All kind of statistical arguments at some level. And so we're going to take this setting and then we're going to reevaluate it. Okay? Now, there's at least two reasons why we thought this was worthwhile revisiting. The first is that the Wang and Yu paper chose a sample of firms that decided to engage in buybacks within 2 years of legalization. This is what they call the repurchasing firms. Okay. Now, putting aside the fact this is selecting on an outcome variable, this is a set of small minority of firms in the markets in which they examine. It's about 6.5% of companies, and they're not 6.5% of random companies. They tend to be older, larger, they face fewer growth opportunities, and they tend to hold more cash. And so if you take this at face value, even if this were true, that for these firms, legalizing repurchases come at the expense of lower investments, I'm not quite sure if this is bad news. To the extent we're pumping cash out of these low-growth, cash-rich firms, it might mean that we're funding investments in high-growth, cash-poor firms. And if that were the case, perhaps this is good news. There's a much boringer reason why we thought this was worthwhile revisiting, an econometric reason, which is that the original paper used causal evidence based on the traditional pooled two-way fixed effects estimator, which many econometricians recently showed us are not proper don't deliver proper estimates for the usual estimands of interest, like the average treatment effect on the treated. In fact, it's so bad that when you have perfect randomization of treatment, you can still obtain a treatment estimate that's of the opposite sign. Okay? Andrew Baker and Dave Larkin and I show that these problems are quite relevant to the types of research problems that we care about in finance and accounting. And in this particular setting, where you can expect dynamic treatment effects, we think it could be particularly relevant. Okay? All right, so I won't dwell on this. So what do? What we're going to begin with is by replicating their results, but using our own constructed sample. Okay? They do post their data with the JFE, and they provided us with their code, and were very helpful in walking us through what they did. But one of the things that we need to do to be able to extend their analysis to the full set of public companies is, because their data is just on the repurchasing firms, we have to basically construct our own data set. And to make sure that we're doing that well, we want to be able to replicate their original analysis using the data that we construct to just as a check. And indeed, we're able to do that reasonably well. Okay? So now we move on to analyze what happens to the full set of companies. Okay? Again, their analysis essentially only looks at 6.5% of the list of firms in the affected jurisdictions. Okay? And who are they? Well, they tend to be older, larger, have fewer growth opportunities as measured by book to market. They hold more cash. They're more prone to shareholder payouts. So these are the more mature, older life cycle companies. Okay. Now, what happens when we estimate these effects on all firms? We find, on average, okay, that investments go up. This is CapEx and R&D. Okay? And it shows up in CapEx, and the results on R&D is not as robust. So what's happening here? In all of our regressions, we do a specification without controls, and then with their full set of controls that WYY use in their long regressions. Now, these controls, basically, this regression requires non-missing values of all the controls, which substantially limits the sample. So these middle columns, okay, help us evaluate whether or not it's a sampling effect or it's an effect of inclusion of controls. So what this is we're subsetting down to the set of observations that have non-missing values for all the controls, but we don't include the controls. So what this is showing us is that the R&D effect isn't there, not because we've included controls, but because they don't seem to apply for these older, larger, more profitable firms. Okay? All right. We also run more appropriate, fancier econometric estimators. We find very similar results on investment. Okay, now, the rest of the paper is basically trying to figure out, well, what's going on? Why are we observing such a different effect? Why are we getting this positive investment effect? Our hypothesis is that legalizing share repurchases could make it easier for companies to access equity capital, that it facilitates a redistribution of capital across public companies. Okay? Now, we can't, these things aren't registered on the blockchain, so we can't see how dollar moves around. But what we can do is to test a bunch of implications and see whether or not we see the data being consistent with the hypothesis. Now, so the first thing we do is to say, look, this hypothesis would predict that the investment effect is concentrated in non-repurchasing firms. That almost has to be true, and indeed, that's exactly what we find. We see a positive investment effect among non-repurchasing firms and a negative effect among the repurchasing firms. If this is about easier access to capital, what we should see is a shift from debt to equity. We find a shift from debt to equity. Okay. If it's easier access to equity capital, this could lead to more positive NPV investment opportunities being realized, what we find is an increase in ROA, ROE, sales growth, Q, and returns. Okay? And these redistribution effects, we think, should be more pronounced in countries with greater friction on capital access, okay, for which these redistributed capital from repurchase legalization is more likely to stimulate investment activities. Okay? We did 3 cuts on friction to capital access. We looked at countries with capital controls, with greater cash holding inequality, trying to capture this idea that cash might be trapped in a small subset of companies, and with greater equity market segmentation. Okay? So our main takeaway here is, from a policy perspective, we think it should be at least as important to understand what the effect of legalizing repurchases are for the full set of listed firms. We don't find compelling evidence that there's an overall decline, this is in corporate investments associated with legalizing share repurchases, and we think these results caution against blanket restrictions on buybacks, which could potentially impede efficient capital allocation. Look forward to your comments, Wang. Thank you.
And we have Masulis commenting on the paper.
Discuss this paper. I think it's certainly a very interesting topic, and let me just kind of start by looking at an overview of what I thought about what was going on in this this paper. I think the key question is, does allowing stock repurchases help capital markets and firm performance? And so more specifically, does it improve the performance of firms repurchasing their stock? What happens to dividend payouts? What happens to cash holdings, to investment? Does it improve the investment performance of these firms? Are there changes concentrated in those firms that are not paying significant dividends? And then, does it improve the performance of firms not repurchasing their stock? What happens to their dividend payouts? What happens to their equity issuance patterns? What happens to their debt issuance patterns? And what happens to the firm's cash holdings and investment? And the main findings are one that when you look at the firms repurchasing shares, there's lower equity capitalization, there's reduced cash holdings, there's reduced investment. That's not surprising given what they're doing. Firms not repurchasing the shares, more interesting. They invest more primarily in CapEx, not so much in R&D. This is somewhat surprising and I think deserving of some additional analysis. They issue more equity, but they don't seem to issue more debt. And in my mind, that's also potentially a little bit surprising if the overall capital markets are improving. So I'm guessing that this means that there's only an effect on the cost of equity falling and not on the cost of debt. And they exhibit better stock performance. But again, this is not too surprising. If they have good investment opportunities, if we've already netted out the firms that are clearly not having a lot of good investment opportunities, so they're buying back their shares. Now, overall, firm performance improves after a company legalizes their stock repurchases. But the key question in my mind in this paper is it a causal effect? And I'm somewhat skeptical about that question. They also do some secondary findings, which I'm totally in agreement with. They challenge the earlier work by Wang, Yin, and Yu. And I think their criticism of the staggered different experimental design is very legitimate. And they also are critical of that study for only studying the firms that are repurchasing shares. And again, I think that's very legitimate because this subsample has very serious selection bias, which they document. And it's also, very importantly, ignores potential spillover effects, positive spillover effects to the non-stock repurchasing firms. So the spillover effect could occur because investors are receiving substantial cash payments from selling some of their shares, which now could likely end up causing them to buy shares in other firms. Okay, so let me talk about my primary concerns here. I think the paper assumes that the quasi-natural experiments that they're looking at, which are the legalizations of stock repurchases, is a clean shock. And that's what I'm wondering about. When do countries decide to allow stock repurchases? Is it when the economy is doing well, on average? I think that needs to be checked. And if it is, then there's another reason why we would see investments and firm investments going up, firm performance going up. Also, when countries decide to allow repurchases, is that all they're doing? I'm suspecting that that's not the only thing they're doing, that they're also making important changes to security regulations or corporation law. There could be some type of liberalization of constraints on foreign investment. Again, I think it's really important to look at the subsample of these events that don't have the economy doing abnormally well, that don't have important changes in other laws and regulations. I think it's also interesting to ask, well, what's happening to these stocks, these firms that are repurchasing stock? Did they previously pay dividends? And so what happens to the dividend payments that are potentially a substitute here? And are the results different for stock repurchasing firms that previously did pay dividends versus those that didn't? Do firms that repurchase shares behave differently if they have good governance? I think that's, in my mind, a really important question. And why is that? Is it because of independent boards, large institutional shareholders, or strong product market competition? And also, do non-stock repurchasing firms that do not issue equity, do they exhibit weaker increases in investment after these events? Now, I think there's a couple of key unanswered questions. What are the incentives of the CEO to back these buybacks, the incentives of the board to buy the buybacks, and are these stock buybacks good for shareholders? I think a little bit of discussion of that would be helpful. But most importantly, do capital markets benefit from legalizing stock repurchases? So do the capital markets become more efficient? Does equity flotation costs fall in terms of the offering price discount needed to sell a seasoned equity offering? Is it now easier to sell large equity offerings relative to before? These are some of the metrics that I think would be useful to investigate over and above what's currently in the study. A few other testable considerations. In the countries that do legalize stock repurchases, do some of these countries limit the size of the repurchases? Do they limit the size of dividend payments? Do they tax stock repurchases more or less heavily than the dividend payments? Do these countries otherwise penalize stock repurchases in terms of heavier regulation, heavier disclosure burdens? Are these results weaker in countries with more corruption, with weaker financial institutions, with weaker disclosure regimes? And I think in terms of all of these questions, you could condition on these to do a stronger test, because you'd expect in most cases that if these things are true, that this will weaken the effects that you would expect. And then I think I'll stop there. Thanks.
Responding.
Thank you, Ron. Great comments and well taken. Let me just, there's lots that we don't know yet, and so you've given us a good direction to go down. I'll just tackle kind of three issues I can talk about at the moment. Yes, we've chosen to think about investment because of the particular debate, but you're pushing us to think about the broader kind of market efficiency issues, which are at some level much more important, and that's certainly worthwhile doing. On the why don't we see increase in debt, all those variables are scale by asset, so we're capturing a relative effect. And so it could very well be the case that the level of debt is still going up, but not as much, not by as much as equity. And finally, and the most important one, is that one of the things that we're doing here is we're taking things for granted that they have a decently good identification strategy, and then you're challenging whether or not that's in fact the case. Now, you're absolutely right that the share repurchase legalization does not occur in a vacuum. We did some work looking into this. When do they tend to happen? They tend to happen when jurisdictions are transitioning from kind of bank-led finance model to a more kind of market-driven finance model. And so you tend to see kind of 2 or 3 sets of like a package of regulations that go along with share repurchase legalization. One is minority shareholder rights, to strengthen them. The second is to pass a set of policies to make the capital market, the financial market, more attractive to non-bank investors. Those are probably the 2 sets of things. So maybe a more conservative statement here is that this is about the effects of share repurchase legalization and the package of regulations that support that. And what they show, I mean, this is true of the former paper as well, which is that this more shareholder-driven type of regulation, they might argue, leads to lower investments when it's accompanied with repurchases, and we're just saying that's not always true across the market. But is it just about repurchases? Perhaps not.
Okay, can we have Maria?
Okay.
Yes.
So I find the result that repurchases can increase investment of the non-repurchasing company very important. And I was a bit surprised that in your presentation, a lot of time was devoted to the comment, because overall, to the comment of the other paper that doesn't use the staggered estimator, but also because it's published in 2021. Okay, so at that time, those papers were not well known. And in a paper I published in JFE 2021, that was a robustness test, right? So you confirm the results, and I find your contribution to be the economics. And I actually would try to tell what's happening in the aggregate. Are the non-repurchasing companies smaller, or is aggregate investment increasing? I mean, it's a back-on-the-envelope calculation, but it would be a very nice headline number. So.
Thank you.
We'll have Eric first, and then Hyun, and then we'll go for the second round. All right? We'll have the second round. Yes.
Great.
Eric.
So, super interesting project, Charlie. I'm going to chase down a couple of points that Ron was making, maybe make them a little sharper. So, on some margin, share repurchases and dividends are structural substitutes for one another. They're both alternative ways to deliver value to liquid value to stockholders. And on some level, I guess I'd want to kind of understand a little bit better how that interaction works. Like, I'd almost want to kind of see a structural model of signaling, right, where you're deciding between whether returning or not, and modulo returning, whether you're going to return via dividend or a share repurchase, and whether it would matter.
You want me to do this in this paper?
I don't know. Like, I wouldn't object. Let me put it that way. So, and I guess on some level, I guess that kind of leads me to some points that Ron was making about the complexity of defining what do you mean by treatment here, right? So the idea of legalization seems binary, but it almost certainly is not binary. And I know that your defense here is probably, well, I'm just sort of the Blanche Dubois. I'm depending on the kindness of strangers, of people who have written, have already put together this identification strategy, which, by the way, I'm criticizing anyway. So, I guess I would want to know a little bit more about this, right? Is it a regulatory posture, like guidance, pronouncements, executive orders? That's the legalization thing. Is it statutory rules to some extent? Is it basically saying we're going to keep them illegal, but we're going to stop really enforcing it? That's another form of legalization. And then when Ron had also suggested things like changes in securities law and corporate law, but I guess I would lean harder into tax treatment, right? Because on some level, full illegalization or legalization can be modeled as a change in the effective tax rate from infinity to zero, right? Or to whatever the applicable long-term capital gains rate is. And there is a ton of variability in both absolute and relative tax rates on dividends and share repurchases, including the United States. And that might give you a lot more power to implement, staggered D&D on an intensive margin as well as an extensive margin.
Great, thank you.
Kyung-hoon, yes, last one before you answer.
Thank you for your presentation, and I have one question. So the effect of the share buyback may be different depending on whether you should cancel the shares right after the buyback. For example, the shares can be canceled right after the buyback, which is common in United States, and in which case its effect may be same as the dividend payout. But in some jurisdictions, the companies tend to keep the shares as a treasury shares right after the buyback without canceling it right away and reuse it. For example, they may resell these treasury shares or use them as an underlying asset for example, exchangeable bond. So I think the effect may be different. So I have a question whether you have chance to look into this matter.
Yeah, so, there's a running thread here, which is you all want me to write a different version of the paper from where we started. And where we started was much more of a replication fight paper. And we realized over time that people hate that. But these are, so there's, surprising that a law school professor would be pushing me to tell him more about the law. So there's a lot of variation we haven't currently exploited and some kind of high-level statistics that would be quite useful for economists, financial economists. This is probably the right direction to go. And I was just reading the paper this morning thinking paragraph 4 of the paper should be entirely rewritten. It's too much about their paper, but not about what we're doing. And that's probably the right anchor for our next revision. The topic of dividends came up a couple of times here. Let me just tell you a little bit about the results here. And it's kind of interesting that in the Boname and Kale review of this literature, in which they do cite this particular Wang and Yu, they don't cite the paper to discuss their evidence on investment for reasons that I don't quite understand. But what they do cite the paper for is the fact that what they find is a quite surprising positive relation, a complementary relation, which the paper also touts as a new result. That result to us, when we try to replicate even within their sample of repurchases, we try to come up with different identification strategies. This is all now in the online appendix because that's not the paper we want to write. I would say that result is not quite robust, as robust as others. And it might also suggest that there's something else going on here. It's not just about repurchases legalizing. There are some secular trends happening in the capital markets that would drive us to find this complementary relationship.
Okay, Bobby, Marriott, and Connell.
Yeah, so very interesting paper. I'm sympathetic with the finding for its worth, or the conclusion, or the interpretation. But the question I sort of would encourage you to explore is that there seems to be sort of this disconnect between, it's sort of a blunt sort of connection between the repurchases and then the availability of capital leading to investment. And the sort of missing link for me is sort of just from a capital budgeting perspective. You would sort of think, again, to the extent that managers use sort of capital budgeting decisions in sort of a textbook fashion, you would think that there'd have to be some relationship to discount rates and expected returns. So the idea is that, like, is the idea that you have all of these companies with positive NPV investments sort of sitting there ready to be sort of, seized, but for the sort of the absence of capital. That seems to be the premise on which you're operating, and I'm wondering if you might be able to sort of test whether or not that's actually the case, because then I think you'd have more of a sort of narrative that what you're telling is in fact sort of what's happening in terms of like the implementation of these investment decisions, conditional on having more cash.
Ever since this became, an issue, as you've described the history of it, it's always seemed odd to me that one would conclude that larger payouts, whether it's dividends or share repurchases, would result in less investment, in the sense that what that would imply would be, it would imply the recipients were engaging in greater consumption. And so, in a way, I guess it seems to me the real issue here is the efficiency issue and not the level of investment issue. And so I guess I kind of urge you to spin it in that direction. The other thing I wondered about here is in terms of levels of investment. I mean, how does private equity fit into this? Because larger payouts could simply make their way into private equity.
Connor?
So a couple of refinement suggestions, one of which might be feasible, and the other one I think would be very difficult. The first one is CapEx in large public companies has two purposes. One is to invest in new opportunities, and the other one is to smooth earnings. So often CapEx budgets will be adjusted in order to meet investor expectations for the next earnings round. And the person who looked into this most was a chap called Lundquist, who did a public-private comparison of CapEx. It might be, and this varies by industry. The more the industry's share prices tend to respond to earnings news, the more CapEx is distorted to manage earnings. It might be a worthwhile refinement to have a look by industry, treat CapEx by industry. And the other one I think is less likely to work because the data I think is only available in 10Ks, but when companies invest a large amount in different proportions to the previous year, so CapEx by division, if that changes by more than 5%, that kind of CapEx gets penalized initially by the market, but over the long term does well. So I suppose my two suggestions are, you're dealing with CapEx, but CapEx has more than one purpose in public companies, and it might be useful to adjust it to see what the effects are.
Great, thanks for that. I'll just say on Merritt's question at some level, it sounds to me like he's saying, the debate that you motivated the paper with is kind of a dumb debate. So why are you writing a whole paper trying to tell the debate that it's nonsensical? Point taken. But the debate exists. Seems to be impacting people's thinking. And so look, I would love to write the efficiency paper. If it belongs here, we'll do it. But there's
some evidence on it.
Yeah. It is quite odd. I think I've talked to journalists and others about this topic ad nauseum, and it seems like there's this modal way of thinking in which when shareholders get money through dividends or buybacks, what happens is they go and find the nearest restroom, toilet, they put the money into the toilet, press eject, and say, "Screw you, America." I'm sympathetic to that comment, and yet the debate exists.
Okay, Jeff and then Claudia.
Today they don't flush the money down; they buy a Bitcoin. But this is this is a little bit of the spirit of what Merritt was saying. Sort of, I'm just thinking about the case of Japan, which just kind of anecdote. Sort of, one of the big concerns is that large firms are hold on to cash, and one of the big questions is how to encourage them to get rid of the cash, and the activists are all about that, with the view that the cash will be not flushed down the toilet, obviously, but elsewhere used in the economy. So this literature has an odd twist to it, because isn't the question all about the spillover effects? It's not at all about the firms that are the target of the law, the goal of which is to get them to divest cash because they're not good investors of it, and all about the spillover effects. And, you know, to be a little bit critical of, you know, what you're doing, all you're doing is reinforcing the focus on the wrong part of the question, which is not whether the laws change the behavior of the targets of the laws, but whether the spillover effects associated with the change in behavior of those firms is good or bad for the economy as a whole. And obviously that's a harder thing to try to figure out, but isn't that the question? And, you know, again, a replication study, a critical one, raises the importance of a question which is kind of beside the point. And so, I mean, you do great work, you know, with Mark and Jesse, and sort of like on the shape of the economy overall. And so maybe, you know, the suggestion is this is a platform to try to figure out how to assess across many places the spillover effects. And that's maybe easy. You know, I don't know how one does that, but it seems to me that that's the, I mean, I hope that's the next challenge that you'll take on, because you're kind of uniquely positioned to do that.
Last question by Claudia, and then your response.
Okay. Oh, very interesting. So my point was, we do teach in the classroom that in a Modigliani and Miller type of setting that this would be relevant, right? So shareholders wouldn't care necessarily about buybacks or dividends, because they could just sell their shares. They don't need to sell it back to the company. We know obviously that in the real world this is not true, because we have frictions, but my question is more to what extent these frictions are heterogeneous across countries. Yeah. And whether this would have an impact in terms of the treatment and control units that you have. And then the second point, just echoing on what Jeff was saying, because this might raise concern about your STUVA assumption, right? So if you do indeed have spillover effects from treatment to control, this would also be an extra issue for your identification.
Great, so thank you. So just on spillover effects, there's two kinds of spillover effects to worry about here. One set of spillover effects would be within market, but across the repurchasing firms to the non-repurchasing firms. That, in fact, is the focus of this paper. And what we haven't done is to explore how they might differ across different jurisdictions. We're not looking at heterogeneity in the how the law specifically is enacted. That could tell us quite a bit of information about you know, how these kinds of things could improve efficiency, something for us to do. Now, you're raising a different kind of spillover effect that could be more worrisome for an empiricist, which is spilling over to the not yet treated legalizing jurisdictions. That's also plausible, something for us to investigate. There are probably different ways we can construct controls to kind of figure out which markets might be less likely to spill over, but each with trade-offs. Okay, thank you so much.
Thank you so much, thank you. I'll pass the time to Marco, yes.
Thank you.